everyone, welcome to this special edition of Mutual Fund Corner YouTube edition, and I'm Winnie Motiwala. Today we're going to be talking about and focusing on one of the biggest questions that investors face. How do you choose the mutual fund that will help you meet your financial goals? So your goal could be something like saving for retirement or planning for your child's education or simply just building wealth. Finding the right fund, that's going to be key. And to help us discuss that and find out how you can actually build that correct portfolio, we have Prableen Bajpai, founder at FinFix Research and Analytics, joining with us. Prableen, thank you so much for joining in with us, and our viewers are really going to be appreciating because everyone has a different financial goal, and to achieve that, it's key to actually invest in the right portfolio, right mutual fund. What is the first step as an investor that you should be taking when you're selecting the mutual fund? Depending on your financial goals, what is it that one should be looking at?
Hi, Vinny. I think what we see in the little trouble which exists is that we usually don't have clarity on the investment horizon. And, that's really important. That's the first step. So once you know that, you have a goal in mind, you have to have a definite time horizon linked to it. So, for example, your child's education, let's say your child is 3 years old, okay, after 15 years, your child is going to go to college. So now you have that 15-year horizon in your mind. And that will help you decide the kind of mutual fund or investment product that you should be investing into. But if you want to travel abroad, let's say after a year, that gives you a time horizon of 1 year. So the selection would really differ. So the first step is always to, list down your goals and write down the number of years which are there to achieve that goal. So for long-term portfolios, which are, let's say, 7, 10, 15, 20 years away, of course, we advocate that, equities becomes a better choice because we have to fight inflation. Every 12 years, our expenses double. So it's crucial to invest in a product which is a growth asset and which is able to beat inflation. But at the same time, when we're looking at near-term goals or a medium-term goal, so near-term goals has to be something where we have to preserve our capital. So we are not really looking at returns there. We have to be in a debt product. We have to be in an arbitrage fund, something from the hybrid space. And I think that is how investors should initially work on. And then, the detailing comes of how do you select, let's say, an equity fund or a debt fund.
Okay, let's just get a bit more specific, right? Like you said, long-term and short-term, all of them will have a different mutual fund category that will be better suited. If your long-term goal, then obviously you could pick a different mutual fund category, and short-term goal, like I want to go for a trip next year, then what should I be picking up, Prableen? Because that really interested me. What is the mutual fund category that you should be looking at specifically for short term? And long term, you did highlight a few of them in terms of hybrid, but anything other than that?
So let's say, Vinny, if you're planning a trip next year and you get a bonus and you can invest into a lump sum, as a lump sum, then probably you can look at an arbitrage fund because at a higher tax slab, if you exceed that 1 year period, your returns till 1.25 lakhs a year are tax exempt, and beyond that you're paying 12.5% tax. So an arbitrage fund, although it's going to give you returns, equivalent to, let's say, a fixed income product, but because of the taxation benefits, your net, returns would become better. So arbitrage funds can be the first choice. Second can be your debt funds, where you're looking at, like in the current markets, we know that, long duration funds can be a good idea because we're looking at interest rate cuts. So if you can take a tactical call and then position your lump sum, so a year and a half later, you may come out with better returns as compared to an FD. If you're not having a lump sum, if you're going to invest with the SIP route, then because there is no solid taxation benefit, then you can even look at a recurring deposit or an SIP into a debt fund and make your investment. But it has to be something which doesn't really have the volatility of the equity markets. So you'll be looking at safer options here. But if you're looking at the long term, then we are looking at a equity mutual fund portfolio, which will be a combination of, let's say, one large cap, one mid cap index fund, one active small cap fund, and probably one active like a multi cap fund.
Okay, Prableen, I just want to understand, because what if someone is looking to buy a home? but that is a specific financial goal that I want to buy a home 5 years later, maybe. Is there a way that, they could be working in terms of especially a mutual fund goal where they have the stability also, because what if they're taking an EMI loan, that you have the stability to pay plus, that suffices your goal?
Yeah, so let's say if you have to, let's say they're preparing for, the initial payment for the house, and the horizon is about 5 years. Then, Vinny, you want to enhance your returns while, ensuring that your risk is not too high. And that is where a balanced portfolio can really be helpful. And a product, I think, which can give you that you can have the potential of returns. So you're taking the advantage of the opportunities which exist in the market while keeping your risk profile at a moderate level. And I think this is where your balanced advantage funds and multi-asset funds can be a good idea, because you can park in some lump sum. Let's say your bonus comes, some additional inflows come. So you can park in your lump sum and also have an SIP into that to build a corpus for a down payment, for example, for your home. So with a 3 to 5 year horizon, I think hybrid funds can really be a good idea.
Okay. So long-term hybrid funds, because it's more balanced and, that will give you the return as well that you're looking at. 3 to 5 years, you could be looking at that. But Prableen, what is it in terms of important ratios or key metrics that one should look at when you're analyzing a mutual fund? It's not that everyone has those in detail options. So how should one as an investor be looking? Today you have so many options online. What is it that we should look at?
Oh, we love to look at returns, Vinny. That's the problem, that we want to go and, filter with the best performing fund, and we usually select based on historical returns. But that's history. And what we need to look into is the future. So the better idea, of course, you can take a look at the trailing returns or the historical returns. There is no harm in that. But our decision should not be covered by that. So you look at calendar, you look at the trailing returns. But then you should also look at very important metrics. Here is the rolling returns, which will give you a better idea of how the scheme has performed, over a different period. And that gives you that average of the best and the worst during that time period, and a more realistic idea of the returns that you can get from the scheme. So rolling returns is a very important and a crucial factor. Second, what you should be seeing, especially in terms of ratios, is I think you can look at the Sharpe ratio, which is going to give you the returns, minus the risk-free returns divided by the standard deviation. So it gives you the risk-adjusted returns. So if you are looking at higher returns, how much risk are you taking? And that can help you make that decision of selection between two schemes. So a scheme with a higher Sharpe ratio will be better. But again, you can't be totally dependent on it, because what if there is a scheme which has lower returns and lower volatility? Then still the Sharpe ratio will be higher. So then comes the Sortino ratio, which can give you, because not all kind of volatility is bad. So upside volatility is okay. We are looking to contain the downside volatility. So Sortino only captures the downside volatility. That's another ratio which can be seen. And the portfolio beta of the scheme, because that's a simple matrix. So for an index fund, the beta will be 1. And for example, a scheme has a beta of 1.3. So if market rises by 1, the scheme will rise by 1.3 times. And likewise, when it goes down. So these few statistical measures can help you sort of look at the kind of risk-adjusted returns which are being provided. Yeah. And I think more than the returns, it is the degree of risk which should be checked in a particular scheme. And of course, other than that, how the fund manager is, the pedigree of the fund house, these are some of the factors.
Prableen, I just have a follow-up on this, that, does this mean for a short-term goal and a long-term goal, depending on my goal, will I have to check some different ratios or metrics for the fund?
You will have to actually, Vinny, because the choice of our funds would differ. So for long-term funds, for example, for my child, let's say that's 15 years away, I am mostly invested into equity mutual funds. And the ratios that I mentioned are more applicable on an equity fund. So all these ratios will be used for my long-term portfolio. Now for my short-term portfolio or something which is in the near term, if my portfolio is more debt-oriented, let's say. So for a debt fund, I want to check the credit risk in the portfolio. I want to see how healthy the portfolio is in terms of will my money come back or not? What is the yield to maturity? What is the modified duration? So different factors are to be considered while choosing a debt fund. And if we are looking at the medium term, where we are looking at hybrid funds, then I think for the balanced advantage and multi-asset category, I would personally want to look at the downside protection, because as a, this 3 to 5 year period is very critical. So I would want to see how has my scheme performed when the market or the broader market, let's say Nifty 50 has fallen. So for example, 26th of September now till 7th of October, the Nifty 50 fell by about 5.5-6%. So during that time, I would want to see how did my balanced advantage fund or multi-asset fund fall, and I would want to choose something which is able to contain the downside.
Right, and Prableen, lastly, what is one big mistake that an investor with a long-term goal should avoid and a short-term goal should for sure avoid? Like, this is something they shouldn't miss.
So I'll do this short term first. So short term, Vinny, don't be greedy. So short term, you can't make high returns. That is something that investors really need to understand. If you've made, let's say, 50% returns in a defense fund or some other PSU fund in the last 1 year, it may not happen again. So for any near term, short term goal, you should risk and put your money in equity. You must stick to the low risk products and low risk and low return products like the debt space or the fixed income portfolio. And when it comes to your long-term, objectives in investing, then I think there are 4-5 points which investors should avoid doing. Number one, again, you shouldn't be chasing returns, because if you're chasing returns, then you are probably going to exceed the level of risk that you want in your portfolio. You will end up having the same kind of probably thematic funds in your portfolio, or as of now, if we select, probably we'll have more of small caps and thematic funds in the portfolio. The next mistake is, not reviewing. So for a long-term portfolio, it's essential that you review your portfolio. You definitely check if your scheme and your portfolio is able to beat the category and the benchmark returns. And I think a very big mistake is exiting too early. So I'll give a quick example here. If I had invested in 2016 in Nifty 50 and Nifty 150 index funds, let's say, 3 years later in 2019, my SIP returns would have been about 5.5%, and in Nifty 150 index, it would have been minus 2.6. So at that time, 3 years later, when your returns are, so dull, most of investors would want to exit, because they would start comparing 7% is something that I can get in FD as well. That is the time you have to stay invested. So at the end of the 4th year, the returns would have been again roughly around 5.5% in both. But if that investor had stayed invested till, let's say, 2021, so this whole 5-year time period the person completed, the returns would have been in Nifty 50 about 19.5% and about 23.5% in the mid-cap index fund through an SIP. This is the example for an SIP. So exiting too early is a very big mistake, and that shouldn't be done. So you should be happy, in the initial phase of your SIP returns, even if they're in negative, because that's fine. You're going to buy at low NAV. So don't exit too early, and you have to stick to the process. And I think you can reach your goals then.
Absolutely, stick to the process. Avoid all those mistakes that Prableen just mentioned, whether you're a short-term investor with those financial goals or a long-term investor and long-term financial goals. But Prableen, thank you so much for joining in with us on this special edition of Mutual Fund Corners.
My pleasure. Thank you.
And thank you so much, viewers, for tuning in. And we will be back with more updates in the world of mutual funds.